Welcome back to the Deep Dive. Today, we're digging into the Q3 2025 earnings call from Illinois Tool Works, ITW.
Right, the big industrial conglomerate.
Exactly. And their latest update, it really sets up this classic tension. You've got just impeccable execution on one side, running smack into, well, kind of stagnant growth on the other.
Yeah.
So our mission today, cut through the noise fast, pull out that core operational story, figure out the financial levers, and, understand why the market reacted like it did. Because it wasn't straightforward.
No, definitely not. It was a pretty conflicting quarter, really highlights what the market's obsessing over right now. I mean, look at the bottom line. ITW delivered a win.
Okay.
GAAP EPS of $2.81. Mm-hmm. That comfortably beat the consensus, which was around $2.72. So a solid 9-cent beat.
9 cents is pretty decent. Shows management's got control, right?
Absolutely. They're proven they can manage their inputs, manage their costs.
But there's always a but, isn't there? The market didn't just cheer the earnings beat.
No, it shifted focus immediately. Because like you said, while ITW was making money very efficiently, they just weren't selling enough new stuff.
Ah, the top line. That's where the story turns.
That's exactly it. The top line number, it disappointed. Total revenue landed slightly light, $4.06 billion against a $4.09 billion consensus. Not a huge miss, but...
But the organic growth number was the real issue.
That was the velocity problem, yeah. Year-over-year organic growth was minimal, just 1%. And total revenue growth only managed 2%.
Okay, so let's paint the picture here. You've got a company proving it can squeeze world-class profit margins out of sales that are barely moving. Mm-hmm. And the fact the stock actually closed down, 1.7% after the call?
Yeah, down 1.7%.
That tells you everything, doesn't it? It tells you what investors are demanding right now, and it looks like it's growth, maybe even more than quality.
And what's fascinating, I think, is how they got that earnings beat despite the sales miss. We really have to unpack the profitability story, because it's genuinely stellar. It speaks to this deep, durable operational advantage they have. They reported a record operating margin.
Record margin. What was the number?
27.4%.
Wow. For an industrial, that's huge.
It's massive.
Yeah.
And that's a 90 basis point improvement year over year.
90 points in a year is...
Oh.
That's aggressive. But wait a sec. If organic growth is just 1%, doesn't that mean ITW is just, getting incredibly lean while its markets are basically flat?
Uh-huh.
How sustainable is that, relying so heavily on just internal cost cutting?
That's the core question, absolutely. And it brings us straight to their famous enterprise initiatives.
You're right. They always talk about those.
Management explicitly said these internal sort of self-help actions contributed a massive 140 basis points to earnings before interest.
140 points just from internal stuff. What does that actually involve? Is it just layoffs?
It's more sophisticated than that, usually. For ITW enterprise initiatives, it often comes back to their renowned 80-20 principle.
Simplifying everything.
Pretty much. They simplify product lines, cut the bottom 80% of products that take up 80% of the effort, but only bring in 20% of the revenue. They standardize purchasing globally, streamline manufacturing.
So, okay, if they're making more money because they've just ruthlessly chopped complexity and cost, not really because they found big new markets or anything.
That seems to be the main driver right now, yes.
And you mentioned this wasn't just in one or two spots. Margin expanded across almost all segments.
Exactly. 6 out of their 7 segments saw margin expansion. That signals it's a company-wide culture. It's ingrained.
Culture of efficiency.
Right. And that operational excellence, it flows directly into their cash generation. And that's, the ultimate sign of quality earnings.
Okay, let's talk cash then. Because with margins like 27.4%, the cash flow, it should look enormous.
It did. It really did. The cash generation was incredibly robust. Operating cash flow, OCF, hit $1 billion.
$1 billion in OCF.
Which yielded free cash flow, FCF, of $0.90 billion. Now, that's up a strong 15% year over year.
15% FCF growth is nice.
But here's the critical technical detail for you, I think. Their FCF conversion. It's running around 110% of net income.
Whoa, 110% conversion. So maybe explain that for listeners. That means the cash they're actually generating, like physically taking in, is even higher than the profit they're reporting on the books under GAAP rules.
Exactly. Their reported earnings are actually, you could say, lower quality than the real cash hitting their bank account. Earnings are backed by just rock-solid cash flow.
Is that typical for ITW, or is this some kind of one-off thing?
No, this is pretty typical for them. It's really part of their quality DNA. And when you have that kind of reliable cash engine, you have immense capacity for returning capital to shareholders, which is, the other big lever they pull when organic growth slows down.
And ITW is absolutely legendary for that, shareholder return.
Oh, completely. They were aggressive again in Q3. They executed $375 million in share repurchases. And for the dividend investors out there, the long-term holders, they announced a 7% dividend hike.
7% hike. And that extends their streak, right? How long is it now?
It extends their run to 62 consecutive years of dividend increases.
62 years. That's incredible stability.
It's a level of commitment most companies can only dream about. And their full-year buyback plan is still aggressive, around $1.5 billion total. They're actively compounding value for shareholders, even when the broader industrial world is kind of sluggish.
That dividend streak, that's got to be the bedrock argument for owning this stock long term.
It's certainly a huge part of the thesis.
Okay, let's zoom in a bit on the segments. We need to see if those enterprise initiatives, all that efficiency, is it actually connecting to, successful market actions anywhere specific?
Yeah, the discussion around segments was important. And the Auto OEM segment, that was called out as a standout performer.
Auto OEM, how'd they do?
Pulled in $830 million in revenue. And maybe more impressively, a 21.8% margin.
21.8% in Auto OEM is very respectable. That can be a tough, low-margin business.
It absolutely can be bumpy. But ITW seems to be succeeding by focusing on, specialty components, things related to lightweighting or specific EV parts where they have some differentiation.
And does this tie back to that management theme they keep mentioning, customer-back innovation?
Directly. Yeah, that's their strategic focus.
It sounds a bit like corporate jargon, but is it more than that for them?
I think so. They frame it as the engine for, quote, above-market organic growth, and critically, also for pricing power.
Pricing power. That's key.
Especially now. So in auto, for example, customer-backed innovation means working directly with, say, Ford or GM to solve a specific engineering challenge they have. ITW develops a proprietary solution.
And then they can charge a premium for it instead of just competing on price for some generic part.
Exactly. It gives them that pricing leverage.
Which you absolutely need when you're fighting broader economic pressures, like tariffs.
For sure.
Yeah.
And management was explicit about that. They said this innovation combined with the efficiency drive is what lets them offset those persistent tariff costs. They use pricing where they can and supply chain actions, basically using self-help and targeted value add to kind of neutralize those macro risks.
Okay, so operational excellence is firing on all cylinders. Margin growth is there, but it all still runs head-on into that future growth question. And that takes us to the guidance, which seems to be where the market really, threw up a red flag.
That's right. The market turned cautious immediately, and it came straight down to the narrowed guidance they issued. They tightened the full year 2025 GAAP EPS range to $10.40, Connor, $10.50.
Okay, a tighter range.
Yeah.
And the revenue outlook, did that confirm the slow speed?
It absolutely signaled persistent low organic velocity. Revenue growth guided to +1% to +3% overall. But the really crucial number, organic growth, was guided flat to +2%.
Flat to 2%. Oof. For a premium industrial like ITW, that feels like a constraint.
It is. They're still predicting really robust operating margins, 26% to 27%. So the profitability is expected to hold up. But that top-line speed is clearly the bottleneck right now.
So you have this real tension, record margin quality, amazing cash flow, 62 years of dividend hikes.
All the quality signals.
Running right into the wall of this, persistently low organic growth. How did the investor community actually process that trade-off, in the immediate aftermath?
Not well. Not well at all. Shares traded lower right after the call, ended up closing down $4, which is 1.7%. And it was on elevated volume, too, 3.22 million shares.
So heavy selling pressure.
Yeah. The market essentially took that narrative, EPS beat, sales miss, narrowed guide, and interpreted it as a negative signal about overall industrial demand and maybe ITW's ability to overcome it.
And if we put this in context, we look at the broader industrial sector, like the XLI ETF. Is ITW just getting singled out unfairly, or is this part of a wider trend?
Well, that's interesting. If you look at XLI, it's been broadly flat to maybe modestly up over the last few months, year, et cetera.
Okay.
ITW, though, is lagging noticeably. It's down 5% to 6% over the last year, and similar declines over the last 1 and 3 months.
So it is underperforming its sector peers.
It is, and that really highlights the market's current fixation. It seems to be all about growth velocity over operational quality right now. investors are demanding top-line expansion, and that flat to 2% organic guide from ITW, it just isn't cutting it for them.
And we should probably mention this wasn't entirely out of the blue, right? There was some skepticism building even before the call.
Absolutely right. Yeah, there was definitely some notable skepticism heading in. I think Barclays, for instance, had recently downgraded the stock to underweight, put a 243 3 price target on it.
Okay.
So when you have a major firm already leaning bearish, and then the company delivers a top-line number and guidance that sort of validates those concerns, well, it just amplifies that negative market reaction.
Yeah, confirmation bias kicks in.
Exactly. And it leaves you with this big question. Can a really high-quality compounder, one with near-perfect cash conversion planning $1.5 billion in buybacks, can it justify its current, fairly premium valuation when its growth ceiling looks stuck at, like, flat to 2%?
That is the ultimate debate, isn't it? Quality is fantastic, but valuation is always tied to future speed, future growth.
Precisely. ITW is without a doubt an exceptional company operationally, but the valuation multiple it trades at usually reflects or implies a higher growth trajectory than what that flat to low single-digit organic guide suggests right now.
Okay, let's shift gears. We're now moving into our This Is Not Financial Advice segment. This is where we pitch an outrageous but plausible trade idea based purely on the divergences and data we've just talked about.
Right.
So given this gap, we've identified this immense cash flow quality clashing with low growth velocity. What's a potential play here?
Okay, so the setup, it almost screams for what you might call a quality hedge.
A quality hedge. Explain that.
Right. So we fully acknowledge ITW is this exceptional business.
Yeah.
And it's got guaranteed support under the stock price from that massive $1.5 billion buyback program. That's a floor of sorts.
Mm-hmm.
However, that flat to 2% organic growth ceiling, it leaves the stock highly vulnerable to multiple contraction.
Meaning the market decides to pay less for each dollar of earnings.
Exactly. If the macro environment softens further, or maybe just seasonal weakness hits in Q4, that could hit the whole industrial sector, and a low-growth stock like ITW, even a high-quality one, could see its PE ratio shrink.
So you're looking to exploit that potential divergence, the gap between its solid cash flow consistency and the market's impatience with slowing growth.
That's the idea.
What does the actual hedge look like for an investor then?
Okay, so the outrageous but plausible trade here, it might be to implement a synthetic short against the stock. Or perhaps simpler for some, just purchasing some out-of-the-money, long-dated put options.
Okay, hold on. Synthetic short, maybe clarify that for our listeners.
Sure. A synthetic short basically means using options, typically selling a call option and buying a put option with the same strike price and expiration to mimic the risk-reward profile of actually shorting the stock, but often with defined risk or lower capital outlay.
Got it. And this isn't a bet that ITW is going bankrupt or anything?
Oh, absolutely not. This is not a bet against the company's long-term viability at all. It's specifically a hedge against or a bet on multiple contraction.
Yeah.
It's betting that the market will become unwilling to pay the current premium for essentially flat growth.
And why long-dated puts or out-of-the-money options? Why not short-term?
Good question. You'd likely want long-dated options because the catalyst here isn't necessarily immediate. The main trigger points are probably Q4 seasonality playing out. And then, more importantly, the initial color we get on the 2026 guidance. That won't arrive until the next earnings call, likely early next year.
So you need time for the story to play out.
Exactly. If that 2026 guidance comes in and confirms this kind of low growth trajectory is sticking around, that's when the market is most likely to really force an adjustment to that valuation multiple. So this trade, it's trying to exploit the market's current laser focus on the top line, which seems to be overshadowing the really strong foundational margin story.
Yeah.
It's essentially a bet on investor impatience.
Okay, a pretty compelling idea there, designed specifically to exploit that gap between the inherent quality of the business and the market's current psychology. So let's try and wrap this deep dive up. The central operational tension for ITW, it seems crystal clear now.
Yeah.
You've got world-class margins driven by these incredible enterprise initiatives
The 80-20 discipline.
and just immense capital returns flowing back to shareholders. But that's grappling directly with this persistently low organic growth and, those ongoing tariff headwinds.
Yeah, the company is absolutely maximizing every single dollar of volume it currently has. But finding that next new dollar of volume, that's proving really difficult right now.
So, okay, here's the provocative thought we want to leave you, the listener, with today. Given ITW's management has these durable process advantages, that rigorous 80/20 system, all this margin self-help, how long can the company realistically rely just on those internal initiatives and those aggressive capital returns to keep investors happy?
Right. Is operational excellence enough on its own?
Exactly. What threshold of actual sales growth velocity, maybe say 3% or perhaps 4% organically, will the market demand before the stock starts moving decisively higher again, before it fully rewards ITW for its, frankly, impeccable quality?
Something definitely worth pondering as you digest the details from this industrial giant.
Indeed. Well, thank you for joining us for this deep dive into Illinois Toolworks. We'll catch you on the next one.